The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we took a look at Wednesday's market trade action, we found some green on the screen. It was quietly higher in grains and oil seeds, really across the board. Another solid day with triple-digit gains in cattle futures, which spilled over into lean hogs as well. Gold rocketed higher, some pressure late in the day in stocks, crude oil up about 1%. A lot of dynamics still, of course, at play, but I would say a quieter market trade so far this week as we gear up for a 3-day holiday weekend. Let's talk about things. Joining us for market analysis, Mike Zuzolo with Global Commodity Analytics. Mike, good to have you here as we're already nearing the end of the trading week with Good Friday, no markets on Friday. And I would say just overall, it feels like a little less volatility at play here across the board as we've gone through a couple days here this week already.
Yeah, I agree. I think that 90-day pause on the tariffs, Jesse, has done a lot to soothe the sentiment and kind of create less momentum and jerkiness and volatility in the trade. Maybe a little bit of an exception on Wednesday's trade versus Tuesday, because as you said, gold made another new record high. Feeder cattle made another new record high. The dollar was stuck back down towards its 3-year low for almost the whole session. And as you say, the crude oil market was able to find a 1% to 2% gain on the session. So we found a little bit more on the tariffs through the gold and through the dollar. But, you know, when you look at it big picture and panoramically, it seemed to me that it was a lot easier to buy the commodities on Wednesday. And I think that goes back to that weaker dollar. One thing that was disappointing to me was that we didn't see the potential for a weather market to really kick into higher gear with a lot drier Western Corn Belt weather forecast than what we were dealing with on Monday and early Tuesday, and also a lot drier hard red wheat belt too. We came around towards the later part of the day after the noon models, but didn't get what we wanted. I'm guessing it's because of some of the new World Trade Organization data that came out.
Well, let's talk about that WTO data, and that's a good spot for us to start before we get into some more of the supply-demand fundamentals here in the market. Walk us through this new data that came out here from the WTO and why this is of significance, Mike.
Yeah, left-hand chart is the merchandise trade. That's what we really care about in the commodity sector. I mean, obviously, merchandise trade and GDP are linked together. But the services, influences the GDP so much more. So I like the merchandise trade. These are really the first numbers that we've seen by anybody, quote, reputable, unquote, that has big enough databases and computer-driven information to chew through to be able to get something like this laid out. And what the WTO did was they used 2019 pre-pandemic time period for the 100% level in terms of trade. And so if we're doing as good as we were back in 2019, we would be at 100. What they came in today and said was, okay, our baseline forecast for 2025 was to build and go up to 110% or 10% more trade in merchandise volume versus 2019. And then by 2026, be near 115% or 15% more. What they did today, though, and that this is the green line, they gave us a 0 increase from 24 to 25 now, and they gave us a bit of an increase up to a 10% better trade in 26. But I believe what the trade really looked at, and I don't have this chart here, but I looked at a lot of the report, the agricultural and fuel merchandise trade kind of got slammed, if you ask me, compared to what their previous baseline forecast was before they integrated this tariff move that we see now in global trade. And so that merchandise trade green line translates into a lower GDP on the right-hand side, 2.2% in 2025 adjusted versus 2.8 earlier in their baseline numbers, and not as bad in 2026, just 0.2 percentage loss. It's really 2025 that gets whacked in terms of trade and pulls GDP down. North America is one of the big hits in terms of GDP. Asia is another one of the big hits. So I think that's probably what created less of an enthusiastic market in some of the commodities as a result.
Well, and I'll add to this piece as well. I know something that you were tracking, and we've touched on this, is with all the tariff concern and more. How does the Chinese economy look moving forward? And you mentioned that a little bit with the Asian economy, and then we get data like this as well. And it's interesting to start putting some of these puzzle pieces together, Mike, and how the broader macros influence the commodities.
Yeah, I agree. And Wednesday, I think this is kind of hard because it's almost like I'm talking out of both sides of my mouth here. The merchandise trade was a negative number. China's GDP for first quarter at 5.4%, very strong. And the trade was surprised by that. But they also realized that there was a lot of buying ahead. And that goes to our retail sales numbers that did better than what the trade was thinking that came out this morning for here in the United States. And so I think the trade is understanding very current, real-time data is really, in fact, being demand pushed forward. And, a week ago, you and I talked about the idea that we weren't far from taking out a major low in the dollar index and being at a 3-year low. And I said, in fact, I hope next week at this time we can talk about that because of the way this chart looks. And we did that. And that's really supportive of this market right now, especially with interest rates and bond yields not climbing. And I think that's why some commodities were favored over others. I once again would say the wheat market was the most disappointing, especially hard red wheat, but it makes sense even with the weaker dollar. The market just isn't willing to buy the trade buy the wheat because of some of this trade data.
Well, this trade data, and then I think we need to talk weather here a little bit too, Mike. And I'll pull up a drought intensity map that you shared with me on the video feed. And it just seems that we have all this data that's coming out, and we continue to watch the headline risks. But more and more, I feel like these markets are coming back to some of the fundamentals like weather. Talk about this a little bit.
Yeah, and I think they should come back to it. And this is an interesting dynamic between now and when we come back from the long holiday trade. And I want to say right off the bat, I'm maybe pushing a little bit hard in terms of the market and wanting to see more of a weather market atmosphere and drive prices up by scaring the shorts who saw a lot of rain in the Western Corn Belt and the hard red wheat belt earlier this week become more disappointed as we get through the Monday, Tuesday time period and the next 5-day rainfall totals being much lower than what they were on Monday and early Tuesday. But, oftentimes I remember in history on a 3-day weekend, especially in the early summer, starting in April, May, June, July 4th time period, even, you can have a trade that wants to wait until the actual rainfall totals are in. And when we come back on, say, Sunday night on Easter Sunday, and then maybe they want to go ahead and cover a lot of short positions and turn the market around. But this model map, this 0 to 40 centimeter drought map, surface moisture map, really shows very clearly the dire situation that central Nebraska through central Kansas and into parts of the Oklahoma and Texas panhandle are in right now, Jesse, when it comes to the lack of rainfall. And planters have been running at a terrific breakneck speed here in this part of the country and on north and northwest of me. I talked to a really good client just north of me, a county away, in fact, and he's going to be finished up with his corn by the end of today. He'll be done with beans by Good Friday, it sounds like. And that's not an uncommon occurrence to hear from the clients I work with in Kansas and Nebraska right now. So I think this map really matters. One thing that I didn't see happen on Wednesday was the trade didn't see this map really matter.
We're having a conversation with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Mike, as we look at the grain markets, I've noticed some interesting spread trade action here as of late. So let's take a look at some of this, and let's start with the July Deese corn spread. What stands out to you? What are you watching here closely, Mike?
This is the spread that was our South American weather spread, and I want to say it could become our U.S. weather spread because of that map we just looked at. I'm putting a lot of stock in this spread, Jesse, when it comes to exactly that, and then also whether I need to get 25 hedges made in the corn market. And so we're at a very critical point here at around 22, 24 cents premium to the July. You notice the last 4 days of trade in a row, this spread has broken. We have reduced the increase or the premium in the July. We're trying to work back towards a carrying charge market, not just in July D's corn, but July Nov beans since the WASDE report came out. And I think this is why wheat is so critical to the corn market right now. But what I would like to see is that this 22 to 24 cent level hold, and we actually go back towards the highs from the post WASDE report up there around 37 cents by about a week from today. And we've got this bull spread clearly back in charge, and we've got a support trend line and a moving average that we can utilize to pull triggers if it does indeed switch back on us. But that's kind of the marker that I'm setting down here in the pre-Easter holiday weekend. I would think, given the sales to Portugal, the sales to Spain, the tightening by the WASDE report, and then this Western Corn Belt drought that we're under right now, I would think the trade would understand farmers are not going to want to sell west of the Mississippi River if they stay droughty. They're not going to want to sell east of the Mississippi River if they get another big rain and they can't plant as aggressively as they need to, and that this spread should show that up.
Well, thinking about how the soy complex has rallied here as of late, seems to be holding its rally in the futures market right now. Let's look at the Nov soy D's corn spread. What stands out to you here? Has anything really changed with this spread as we're getting into the spring planting activity and more here, Mike?
No, not a lot. The one thing you can notice here is the white line the white bars are the December corn futures. Earlier today, we were able to get up towards the 480 level, I think it was. Yeah, the 470 level. 469.5 was the high. That took us to price levels not seen since late February. And you can see that and how much we've jumped above the last trading range band. The November beans, almost the exact opposite. They're still stuck in a trading range band, not having the force to be able to go through the late March, early April highs. I think what happened on Tuesday before the weather shifted and got drier and corn and wheat wanted to play more of a firm price action was the soybeans probably went back and had to trade the WASDE report. And it's very hard for me to get over the U.S.-China relationship combined with a record world ending stocks for soybeans. I'm guessing the trade's probably having the same situation in their minds at this point. So I'm right back to where I need the corn and the wheat to lead this market higher. Beans I'm much more nervous about as Brazil wraps up its harvest. And the Trump administration has done several things now to really isolate China when it comes to the trade and when it comes to the tariffs. And so I think the likelihood of them doing something in terms of canceling our soybeans, the percentages and the likelihood and odds just continues to go higher.
All right. I want to spend some time on the cattle market with you here today as we work through the tail end of our program. And let's look at the monthly feeders chart. And you mentioned earlier we got some new highs in feeder cattle. It's really been a nice couple of sessions in a row here this week for both feeder cattle and live cattle futures as we gear up for this cattle on feed report coming on Thursday. Let's start on the feeder side. What are you tracking here this week, Mike?
I think Oklahoma City really set the tone along with Wall Street to be able to give us this kind of a price, because I was shocked to hear that the steers over 800 pounds were $4 to $10 higher, Jesse. I was really shocked to hear that under 800 pound steers were $20 to $25. And so they were recording 7 to 730 weight feeder steers at 321 in Oklahoma City, get upwards of 770. They were still at around 292 on an average. And I think that really gave the feeder contract the ability to move higher. And the fat cattle and the hogs weren't fighting because Wall Street was finding some support.
Well, how does this play into, you look at a monthly feeder chart and then we look at the feeder fat spread? I mean, we continue to track this as well, and it looks like that spread's starting to tick upward again, Mike.
Yeah, we're starting to still bounce off that $84 level again in terms of the April feeders minus April fats. You notice in the top part of the chart, the feeders in blue having a much straighter line higher, kind of like the corn market, versus the fat cattle, which looks more like that soybean chart, where we've kind of found a plateau of upside, and that old high of around 211 plus in lead month fats, we haven't been able to try and ring that bell yet. And I think that's where it goes back to when you look at this chart, Jesse, and you go back to 2014, 2015, you can see how the feeders made a high about a month before the fat cattle made a high. And I still really like the 2014, 2015 type scenario in terms of this current market, especially given that we do have some ample supplies of market ready cattle for the next 30, 60 days. And especially given the fact that the Wall Street relationship, the equities relationship between the fat cattle and the S&P 500 on a 5-week basis is still running 75 to 85% positive in terms of lead month futures prices. So it would make sense to me that still thinking that April fat cattle probably going to be the majority of the rocket fuel to lead us to the highest levels. And with these new all-time highs in feeders, that kind of shores up my mindset that feeders are making their move now. By the time the May takes over as lead month, we've probably expended a lot of energy to the upside, and we're going to really need an environment to feed the bull.
I wonder, cattle on feed report coming Thursday, could that throw the cattle market any sort of curveball? Are you getting any indication of that, Mike?
I'm not right now, but I don't think the trade really knows what we're going to see when it comes to the cattle and feed numbers. I think we're generally thinking that the top is in terms of placements because of last month's numbers. But I think that's the question that I would have is, okay, how much lower are we versus last month, or are we even with last month? The other thing that I would throw out that I've heard from a couple different corners is the Packers are back to backing up the marketings right now to try and drive prices down. I think they've been pretty effective, but that would also mean that in the post-Easter holiday, they're probably a little bit short bought. So my sense is the short term, next 1-2 weeks, we've got some upside potential in the cash fat cattle. Be current on your marketings. Be excited about the next 30 days, or excuse me, be a little bit more nervous about the next 30 days where we have a lot of market ready cattle. But then as we get back into the third quarter or closer to the third quarter, we tighten up and you can get, I think, a little bit more excited again about maybe coming back around. But it just depends on how much of a break to the downside we see. Is it going to be substantial like what we saw in late 2014?
Should ask you on that hog market. Any notes there? We found some support, I think, maybe spilled over from cattle on Wednesday. What are you watching in lean hogs right now, Mike?
Yeah, the June lean hogs have been able to make up almost, I think, $8 in 5 trading days. And so they've really come off their lows nicely. I think, again, that's Wall Street. One thing I think differentiates pork from beef right now, Jesse, is our export market. I don't think Europe has a lot of pork right now because of disease problems. Those weekly pork export sales have really continued to shine. And with this 3-year low in the dollar, I think the trade is maybe pricing that in to the summer future. So if we get good exports, I think we can maintain these kind of price levels. But with that Easter seasonal over with, if we'd see the exports slip, I think the hogs could take a dip then.
Mike, any other final thoughts you would share or reiterate with folks today?
I think the market's pretty sound at this point, Jesse. I think we're at a point now where with this tariff situation in U.S.-China trade is we've lined it out to where both countries are going after Asian business and European business, and whoever wins the bilateral trade, it's almost like monopoly. Whoever gets Boardwalk and Park Place really has the leverage going into the rest of summer and into fall. So if China makes a lot of deals here, that kind of puts us on our back foot and vice versa. So I'm hoping the United States can secure Europe and Japan really quickly and then follow that up with South Korea and a couple other key countries. And that, I think, would maybe then bring China to the bargaining table and make them want to make a deal with the United States, and we can get back to normal relatively quickly.
Mike, if folks want to reach out to you and have a conversation, take a look at your analysis and more, how can they do that?
Best place is globalcomresearch.com. You can get a free 2-week trial there. So please go there and sign up.
globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. I wish you and yours a happy Easter weekend ahead, and we'll talk to you again next week.
Easter blessings to you and your family and all the great listeners out there, Jesse. Thank you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.